Wall Street is weighing in on the possibility that we'll see the Fed cut rates this year. Now, JP Morgan and Barclays both predicting that the Fed will in fact cut rates this year. But Goldman Sachs, on the other hand, isn't jumping on board just yet. They noted that it's still too soon to tell. Well, we also had remarks from St. Louis Fed President James Bullard earlier today, saying that a rate cut, quote, may be warranted soon. Joseph Minarik, chief economist for the Committee for Economic Development and also former OMB chief economist under President Bill Clinton, joins us now. And Joseph, when you see those types of, I guess, contrary points of view, JP Morgan and Barclays both saying that we will get a rate cut this year, Goldman Sachs saying that they're not sure about it, Bullard coming out saying that, hey, we could get a rate cut before the end of the year. Where do you stand on all of this?
The fact that you're hearing different opinions is a strong indicator that there are influences cutting both ways. The Federal Reserve does not want to wind up chasing the market and chasing rumors. Interest rates are already low, which means that the Federal Reserve, if it chose to cut interest rates now and proved to be unnecessary, would find itself on the back foot if somewhere down the road you had an economic slowdown. They'd have less room to cut rates to help the economy to recover. A lot of what you're seeing going on in the markets is a response to policy changes that some might say are really causing self-inflicted wounds. There's a concern that we might straighten up and fly right on the policy front, defuse some of these concerns about a trade war, and all of a sudden the Federal Reserve would be turning around on its heels and starting to raise rates again. It's a really tricky environment for the Federal Reserve right now, and I think that's part of the reason why you're hearing people arguing back and forth with some ferocity about what the next move is.
Just the last time you were on the show back in April, you said that the biggest risk to the economy is worsening trade dispute. I mean, the trade dispute between the U.S. and China has certainly escalated since the last time you were on the show. So, I mean, what kind of impact are we talking to the U.S. economy when it comes to the U.S.-China trade war continuing to escalate?
Well, where we are right now is just an environment of incredible uncertainty. Businesses don't know what the next move is. They don't know whether disputes are going to be settled or whether they're going to be worse. The president is talking about raising tariff rates at some point in the future if certain conditions are not met. If you're a business and you are operating on a supply chain that crosses borders, you're concerned that if you switch suppliers to higher cost suppliers, obviously you're going for where you can get the best prices for your supplies and for your processing. You're not going to switch unless you believe that a tariff war is in fact going to make your current suppliers non-viable. But making that change, that's a quantum decision. That is making an increase, incurring an increase in costs in terms of the market to avoid a tariff that otherwise would make things worse. You step across that threshold, it has an effect on your own costs. You don't want to be on the wrong foot there. You don't want to make that move and then suddenly discover that the tariff situation has been resolved. So it's tremendous uncertainty. Businesses are hesitant to act. When businesses are hesitant, that means that we're missing opportunities for economic growth.
Joseph, what do you make about the fact that some tariffs are being used for issues that aren't an economic problem? And I'm talking about the fact that the Mexico tariffs are being threatened because of the immigration issue. I mean, is that something that should be avoided, do you think?
Yes, it definitely should be avoided. And the fact that it's on the table right now means that businesses are facing even greater uncertainty. If we're going to have changes in tariff policy with respect to immigration today, what's going to come up tomorrow? There is no predictability in this environment. And without some sense of certainty, some sense that there are guardrails out there that are telling you where policy is going to go, businesses are going to be much more hesitant about making commitments that might conceivably be undercut by changes in policy.
Joseph, President Trump's top economist, Kevin Hassett, stepping down today. That was, or is going to be stepped down. That was announced, I guess, last night in a tweet. Just in terms of what the impact this is on the Trump administration, would you say that it's a negative?
I don't know that I would say that it is a negative. People tend to take those positions for, on the order of 2 years. It's not unpredictable that somebody who served the beginning of a Trump administration, now that you're past the midterm elections, is going to look for something else. What I think would concern you would be if you were looking for a situation where there was some turmoil in terms of the policymaking apparatus within the administration. I don't think that this transition is an indicator of turmoil so much as relatively predictable changes in personnel from folks who do their time in a political appointment and then move on.
All right, Joseph Minarik, thanks so much for joining me today.